8 states in America will tax your Social Security check in 2026. And one of them starts taking money the moment you cross $50,000 in income with no real exemption to protect you. That's roughly $371 a year gone from a benefit you already paid into for decades. But that's not even the worst part. The federal government set its Social Security tax thresholds back in 1983 during the Reagan administration and hasn't adjusted them once for inflation in 43 years. That means the same income brackets designed for an era when gas cost $1 and a house cost $70,000 are now pulling millions of Americans into benefit taxation who were never supposed to be there. One of these 8 states has the highest income tax rate in the country on people collecting benefits. Another looks expensive on paper, but actually charges the average person nothing. And the state with the heaviest total tax burden on people over 65? It doesn't even tax Social Security at all. Subscribe if you enjoy knowing where your money goes before it disappears. Let's break it down. First, you need to understand the federal trap, because it's bigger than any state tax and it affects everyone. The IRS uses something called combined income to decide how much of your Social Security gets taxed. That's your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits, all added together. If that number crosses $25,000 as a single filer, up to 50% of your benefits become taxable. Cross $34,000 and it jumps to 85%. For joint filers, those thresholds are $32,000 and $44,000. And here's the part that deserves more outrage. Those exact dollar amounts were written into law in 1983 and 1993 inside the halls of Congress. They've never been updated, not once. If they had been indexed to inflation, the threshold for single filers would be over $73,000 today instead of $34,000. That gap between $34,000 and $73,000 represents millions of Americans getting taxed on benefits that were never supposed to be touched. In 2024 alone, taxation of Social Security benefits generated $55 billion in federal revenue. The government has no incentive to fix this. Now, Congress did pass the One Big Beautiful Bill in July 2025, which created a temporary $6,000 bonus deduction for every American 65 and older. The White House says it shields 88% of Social Security recipients from federal taxes on their benefits. On paper, that sounds great. In reality, it expires after 2028. 3 years of relief, then right back to the same frozen thresholds from the Reagan era. And if your income is above $75,000 single or $150,000 joint, the deduction phases out entirely. So the people who need it least are protected, and the people getting squeezed hardest still owe. That's the federal picture. Now let's talk about the 8 states that add their own tax on top. Here's what nobody tells you. 7 of these 8 states have income exemptions generous enough that the average person collecting Social Security pays absolutely zero in state tax on their benefits. Colorado exempts 100% of federally taxed Social Security for anyone 65 and older. New Mexico exempts everyone under $100,000 single or $150,000 joint. Connecticut caps taxation at 25% of benefits even for high earners and fully exempts anyone under $75,000. Rhode Island exempts anyone at full claiming age with income below $107,000. Minnesota's exemption threshold sits at $84,490 for single filers and $108,320 for couples, among the most generous in the country. Even Utah, which taxes all income at a flat 4.5%, offers a Social Security benefits credit that wipes out the tax for single filers under $54,000 and joint filers under $90,000. The state legislature raised those thresholds in March 2025 to protect an additional 90,000 people. So if you're earning a typical amount on a fixed income in any of these 7 states, your Social Security state tax bill is $0. But Montana is different. Montana follows the federal rules for calculating taxable Social Security and offers only a $5,500 subtraction for people 65 and older. There's no income-based exemption like the other states. At a tax rate between 4.7% and 5.65%, a single person in Helena or Billings earning $50,000 a year with $24,000 in Social Security benefits would owe approximately $371 in state tax on those benefits alone. That makes Montana the only state where a moderate-income American reliably loses money on Social Security to the state government. Not a fortune, but $371 a year over 20 years is $7,420 that didn't need to vanish. And then there's Vermont. The Green Mountain State fully exempts Social Security when your income stays below $55,000 single or $70,000 joint, thresholds that were raised by $5,000 each in June 2025. But once you cross that line, Vermont's progressive tax rates climb all the way to 8.75%, the highest top rate of any state that taxes Social Security benefits. A person in Burlington earning $80,000 with Social Security income could face a meaningful bite from the state capital in Montpelier. Now here's where the conversation gets interesting. 4 states eliminated their Social Security tax between 2024 and 2026. Missouri and Nebraska both dropped it in 2024. Kansas followed in mid-2024 after a special legislative session. And West Virginia completed a 3-year phase-out on January 1st. That's 4 states gone from the taxing column in just 3 years, saving their residents a combined $750 million or more per year. The momentum is real. Lawmakers in all 8 remaining states have introduced repeal or reduction bills. The political pressure is building because this issue polls above 80% support with voters. If the trend continues, most or all of these states could drop the tax within the next few election cycles. If you're finding this useful, hit subscribe. I break down the real numbers behind where Americans should and shouldn't be living every single week. Now here's the twist that changes everything about this conversation. The total tax burden on people living on a fixed income has almost nothing to do with whether the state taxes Social Security. The states that hit hardest are often the ones that don't touch your benefits at all. Take New Jersey, 0 state tax on Social Security. But the average person over 65 in New Jersey pays approximately $9,100 per year in combined state income tax, property tax, and sales tax. Property taxes alone average around $6,600 on a $300,000 home. That's more than the entire annual tax bill in Wyoming. New York doesn't tax Social Security either, but its total state and local tax burden averages $12,865 per person, according to a February 2026 analysis. On the other hand, Vermont taxes Social Security, but its total burden sits around $8,600. That's almost $4,300 less per year than New York, which doesn't tax benefits at all. Over a 20-year span, moving from a state like New Jersey or New York to a state like Wyoming or Florida could save over $100,000 in cumulative state and local taxes. That's not a rounding error, that's a house in some markets. The bottom line is this. If you're making under $75,000 a year and collecting Social Security in 2026, you likely owe 0 in state taxes on those benefits in every state except Montana. The federal deduction protects the vast majority of beneficiaries through 2028. But that federal protection is temporary. Those 1,983 thresholds aren't going anywhere, and the real cost of where you live goes far beyond whether the state touches your Social Security check. Property taxes, income taxes on pensions, and 401k withdrawals, and sales taxes add up fast, and they don't care whether you're in a state that claims to be tax-friendly or not. You just learned something that could save you thousands of dollars over the next decade. Subscribe so you see this kind of breakdown before your real estate agent conveniently forgets to mention it.